Hello everybody, this is Chuck Cardinal Health, co-founder of FastGraphs, the fundamentals analyzer software tool, and of course one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This week's video is really near and dear to my heart as a value investor. You know, many of you know me as Mr. Valuation. It's a moniker I carry very proudly because I do believe valuation is such a critical part of being a successful long-term investor, regardless of your objective. Even if you're investing for growth, you still want to pay attention to valuation. There they call it growth at a reasonable price. But for the dividend growth investor, which is really pertinent to the Dividend Kings, it really comes down to identifying extremely high-quality dividend growth stocks that can give you that combination of a growing income stream plus some capital appreciation along the way. But one of the real cornerstones of being a successful value investor is this concept of margin of safety. You know, Ben Graham introduced it. Warren Buffett went on to say it's probably the three most important words in investing. And of course, as Mr. Valuation, I couldn't agree more. So what I'm going to do here is I'm going to cover, I went to the Dividend Champions and Aristocrats, and I tried to come up with 10 really high quality dividend growth stocks, champions and aristocrats. Part of the quality factor is the fact that they've all raised their dividends, as I indicated in the written portion, by 25 years or more, with the exception of AbbVie, which actually has increased their dividends since 1973, if you give them credit for what happened with Abbott Labs. But I was really looking for a margin of safety. Now, I want to make a point here that I think is extremely important before I go on. I found it very, very difficult to find anything that had a good margin of safety. I did come up with 10 names. 9 of them I think really do have somewhat of a margin of safety. A couple of them are close. Some of them have a real high margin of safety. But the point is, with interest rates as low as they are, it's getting very, very hard. Now, some of these companies, as you'll see, don't have the spectacular track records that I personally like. Some of the highest quality dividend growth stocks like Ecolabs or Cisco, the food company, SYY, and many others have really excellent, consistent track records. Some of the stocks I'm going to show you today don't. But safety comes in a lot of different flavors. And one of the things that I think really helps, protect a portfolio is the idea of this margin of safety. But it's very, very hard to find in today's marketplace. I do want to make that clear. So these are the 10 names. I got AbbVie, Aflac, Franklin Resources, Cardinal Health, Chubb, General Dynamics, IBM, People's United, AT&T, and Walgreens Boots Alliance. Now I've got these in order of ticker. Okay, and what I'm going to do here with this video is I'm going to focus primarily on the concept of the margin of safety. I'm not going to get too involved in the rest. I'm going to start by showing the historical graph, and this was, spun off in 2012 from Abbott Labs. The idea of a margin of safety, for those who aren't familiar with the graphs, the orange line would represent intrinsic value. The real key to the concept of margin of safety is a stock that you can buy trading at a discount to its intrinsic value. The larger the discount, the safer it is. And one of the things that really struck me when I quoted the article that I saw in Motley Fool was this idea that it really makes the forecast, which I consider to be a key to long-term success in investing, it mitigates it to almost irrelevancy, because if you have a high enough margin of safety, even if the company disappoints you greatly, you can still end up doing okay. But again, margin of safety was hard to find here. So we're looking at a stock like AbbVie here. Let's go into the forecasting calculators, because this is where the margin of safety is really going to be seen here. This would be the intrinsic value. This is the forecast for the next couple of years. And I want you to notice you've got 18 analysts. We have a down year expected in 2023. I'm sure that's related to the Humira patents. But the bottom line is, beyond that, I don't really look too far. I usually look at the next 2 or 3 years tops when I'm looking. And I'm looking for that near-term margin of safety that I can monitor. So if I looked at AbbVie, and if I just point my cursor here to what I would consider its intrinsic value to be, AbbVie is trading at a 59% discount to its intrinsic value. In other words, it's a $165 stock if it traded at 15 times earnings, which there's no reason to think that it shouldn't. If I look at the stock historically, it traded at 15 times earnings or higher on numerous occasions. Of course, the talk of the Humira patent is probably what got the stock cheap in the last couple of years. But the point is, even if the stock disappoints, the normal multiple for the last few years has been even lower at 12 times earnings, I would still have a 30% margin of safety. So my point is, I don't see a whole lot of risk in buying this stock here today from a standpoint of principal loss. I think the dividend is very secure. That's something you can look at yourself. I'm not going to get into cash flow. I got too many companies to cover, but the cash flows here cover the dividends quite well. So does free cash flow. But the point is, I've got this significant discount to the company's intrinsic value, so I can confidently buy this stock feeling like I'm probably not going to lose money, and yet I stand an extremely good chance over the next couple of years of earning exceptional rates of return, as high as 47% annual. That's 100%, 97.8% total return, if you will, or 107% when you add in the dividends that you would expect to receive during that time. So doubling your money, making 47% a year in a high quality dividend aristocrat is pretty, like I said in the article, what a deal. The next one I'm going to look at is Aflac. Now, this is interesting. If you look at it historically, Aflac always traded at a premium to this 15 kind of baseline PE. Subsequent to the Great Recession, however, it has traded at a much lower PE. Nevertheless, I still believe this stock ought to be trading at a 15 PE. So if I measure the margin of safety there, I get a margin of safety of 57.42%. In other words, that's the opposite of the capital appreciation here. I've got a very high margin of safety built into this stock, and I've got a very strong rate of return potential built into this stock. Over the next 2 or 3 years, it could be as much as 33% annualized. To be clear, 65, 66% capital appreciation, throw in some dividends, you've got 71% total return, annualizing at 33%, and you've got this real good margin of safety. Even at this much lower multiple, you still would have the ability to make a double-digit return. And this really is the feature of the margin of safety that's absolutely so important. Moving on is Franklin. Now, I kind of alluded to this one in my opening remarks. Not all these stocks are going to have these stellar track records, but I also pointed out that when you look at the most predictable part of a good growth stock, dividend growth stock like this, it's the white line, the dividend, if you will. Franklin Resources, which is a large, mutual fund asset management and custody bank firm, very famous for the Ben Franklin logo that they have. Well, the company's capital appreciation and cyclicality is real, but yet the company has been able to maintain their dividend growth rate year after year after year, as I indicated in the article, and it has a very long track record of doing that. From a margin of safety point of view, if I look at it just for the near quarter, I've got a 55% margin of safety built into this stock. So even with some cyclicality and some earnings disappointments, I don't really need to be that stellar with my forecast as long as this orange line stays positive. And by the way, even during these down years, I do want you to notice that the earnings stayed positive and that the dividend was actually able to be increased. Even though the earnings for 2, 3, 4 years in a row here were rather weak, the company did consistently raise their dividend every year. And by the way, they've actually grown their dividend at a double-digit rate. So the key here is if I can buy this stock when it's cheap enough, which it clearly is now. It was even cheaper, of course, just a few months ago in March, after COVID, we had this spike down. Well, it's recovered to that level. I still have a very nice margin of safety in an A-rated company with minimal debt, and I think a very good long-term investment, if you will, and certainly an intermediate term. Cardinal Health is another one, very high-quality company as a healthcare distributor. There's obviously the concerns about opioid epidemics and so on, but this company keeps generating good earnings results. Their dividend growth rate has slowed down quite a bit here in recent years, but they've still been able to maintain their dividend status. If I look at it from a standpoint of margin of safety, the company has a 68% margin of safety at these levels. That's very, very strong. So even at, lower potential multiples, I would still have a 36% margin of safety if I only used a 12 PE, which has been the normal PE for the last 5 years is what that means. So I've got this safety factor built in based on this low valuation, and you can see the stock has gotten very significantly undervalued in the past. those always turned out to be real good opportunity, at least for the next intermediate term, to be investing in this stock. I think that's the case now. Hasn't gone anywhere in a couple of years, but it does pay a nice 3.71% dividend. It's got an earnings yield of 11%. I believe this is very attractive from a standpoint of margin of safety for a dividend growth stock. Chubb is the one that I mentioned that I had to use to round out my top 10. I really couldn't find 10 names that I was extremely comfortable with. So Chubb's margin of safety really comes from what I think forward earnings are going to be. So technically, I wouldn't say this stock has a margin of safety. But on the other hand, I do think it's a high quality company that, because of the drop in earnings here and the recovery going forward, if I go out even a couple of years, I do have a potential to make at least a double-digit return. So again, the point is to use this particular example is that it's very, very hard to find stocks with a margin of safety today. But if you're willing to look, they're out there. The next one is General Dynamics. Now, this would have been a better story about 2-3 months ago. You can see, though, I've featured this stock in several articles. It had very low valuations. Any of these times were a great time to buy this stock, as long as you were willing to hold it long enough. And then we saw overvaluation manifest on a couple of occasions. We saw the reversion to the mean. It got pretty undervalued. It had a really nice margin of safety a few months ago, I think, when I first was featuring the stock. But today it's got, essentially a no margin of safety, but it is attractively valued. So, I guess you could say I'm pushing it with General Dynamics as well. But the company does have long-term potential, and it's a great stock. You just don't have that huge margin of safety we've seen with some of the others. My next example is IBM, and IBM is similar to Chubb's story. The company is clearly a company in transition. They've been moving from their legacy businesses to their cloud-based businesses, and it's now beginning to bear fruit, at least based on what the analysts are expecting. So if I look at these normal low multiples of 10 or 11, there's not a lot of margin of safety. But, IBM, in my view, an A-rated stock, iconic tech stock, ought to be trading at 15 times earnings. That would give me a margin of safety of about 15% or so. Out towards the end of this year, that would balloon up to about 37%. So I do believe, the value in IBM is its low valuation right now and significantly above average dividend yield. You've got to be patient with a name like this when the company's going through a transition. The next example is People's United Financial. The earnings are kind of flatlining, and this is one that really showcases the idea that your forecasts don't have to be that good because, the current margin of safety on this stock, moving out to the end of the quarter, the next quarter would be about 26%. If I go all the way out 2 or 3 years, it would still be 29%. And, that's before any of this happens. So I've got a good opportunity to buy almost a 5% dividend yield with a long record of increasing their dividend at a real low valuation. Once again, when the valuation was really low back here in, 2020, that would have been the real time to buy it with a true margin of safety. But it's a good, solid opportunity with a company that does have, and you can see that, it's recovered already dramatically as it came out of the last part of 2020 and then into the spring of 2021 here, we see some good value. Of course, COVID, hit this stock hard like it did a lot of stocks, which created the margin of safety in the first place. The next example I have here is AT&T. I recently featured this stock. It's not growing very fast. This is, again, another case where the forecast becomes irrelevant. The real margin of safety here is about a 22%, 21.6% margin of safety, just based on the stock going back to a normal 15 PE. And when I look at it historically, this stock has historically traded at even as high as, or a higher PE, or at least a 15 PE, if you will. It is a low growth stock, but it does have a good margin of safety. And I think that's the real story here, based on the fact that we've got a 7.25% yield while we're looking for it. It's not going to make you rich, but it should give you a stable income that might grow moderately, although not very fast, especially recently. Walgreens Boots Alliance had a tremendous margin of safety just a month or two ago. It still has a very strong margin of safety, averaging over 43%, almost 44%. And, it's an extremely high quality, drugstore. I think it's a major demographic play. It's got almost a 4% dividend yield. and again, a long history of increasing their dividend. Once again, I want to bring your attention back to the point that the white line on this graph is the most predictable, most consistent line, more consistent than the orange earnings line, more consistent certainly than the jagged price line. So dividends are one of the most predictable aspects. Now, in talking about how difficult it's been to find stocks with a margin of safety, this is one I featured in the past. It's a cyclical. This is a large lithium producer. You can see, how the stock got crazy overvalued, then all of a sudden fell into a nice margin of safety. Of course, COVID hit it pretty hard, but then all of a sudden now Tesla's been hot again. It's obviously a lithium producer. And once again, this is what's generally available out there in the marketplace. Another one that's never available to margin of safety is Ecolabs. I've never owned this stock, primarily because I've never been able to buy it at a margin of safety. The market's always valued it at a very high multiple, 25 to 30 times earnings. I've just never been, willing to pay that because I do feel the risk has always been too high for the potential rate of return that I might achieve. And of course, today at almost 52 times earnings, there's virtually no margin of safety. I just added these last two to give you the perspective that, it's very difficult to find quality at value, especially for the dividend growth stocks and in the major, dividend growth stock sector. So here's 10 stocks you can look at in your dividend growth portfolios. They can be mixed and matched to meet different objectives. Hope you enjoyed this, and I hope you got a better appreciation of how important margin of safety actually is. Thanks for watching. Give me a like, ring the bell, do all those nice things for me if you don't mind. I'd appreciate it, and I'll talk to you again soon. Thanks.